So guys, here is a special invitation for Investival, which is an investors conclave, which is going to happen in Bangalore in the month of April from 28th to 30th. This is a 3-day event, which will be a residential event. This is been happening, will happen in Taj Yeshwanthpur, Bangalore. It is a pure. Hi, hello friends. Welcome everyone to Nifty Banker, India's first retail index traders online conference. I am Fazil Ahmed, Director of Education and Events at Traders Gurukul, and also for the host for today's program. It's a great pleasure to invite every one of you to the third edition of this Nifty Banker webinar series. I'm sure by the end of this program, you will have a lot of knowledge which can help you to make better decisions in your trading journey. Let me also like to thank our media partner Money Control Pro, the largest financial portal in India with millions of daily readership on their website. They helped us to reach a wider audience in a short span of time. The speaker for today is Vivek Gadodia. He is the founder and CEO of RBT Algo Systems. He has 2 decades of experience in trading, technology, and financial markets. He is an independent mentor to help traders in their systematic trading journey. Also, he's one of the few algo trader who started his journey in very initial stages. Also, he runs a backtest basket of non-correlated option trading system which can deployed by individual HNIs, ultra HNIs, prop desk, family offices, and hedge fund investors. He is a visiting faculty at BSc Training Institute also. He will empower us today with a special topic called Intraday Options Algos for Non-Programmers. Mr. Vivek sir, on behalf of Traders Gurukul and Money Control Pro team, I extend my warm welcome into our program as an elite speaker. Go ahead, sir. The stage is yours.
Thank you so much, Fazil, for the kind introduction and having me here. It's a fantastic show you guys have put up. Lucky to be called again. I've been seeing your events journey through the last few years, and I think it's just phenomenal work that your team and you are doing. Also, thanks a lot to Money Control Pro for helping to spread the word and reach out to larger audiences. Okay, so let's start delving into the topic of the day. Actually, what's very interesting for this conference, it's specially focused on retail index traders, and I'm sure a lot of us here, some of you would be maybe have started in the last couple of years, some may have been there for a few more years, and I think thing is common, that the intraday trading of the index weekly options is something which is not now anymore, cannot catch the eye of anyone. I mean, it's something which is very, very active, and a large number of people who are even not exposed to FNO, they have now become like first time FNO participants, and they are gaining exposure. So I think it's very, very relevant to have a conference right on this topic, and I'm looking forward to even hear the other speakers and learn. So let's move forward. Right, the agenda is we'll run some slides for about 90 minutes totally, where we'll cover a little bit of basics and intro to systems. Then we'll do some strategies in intraday. So we thought we'll use a tool to show you practically how to build the strategies and how to backtest them. And we'll talk about how to use a basket of strategies rather than just using one strategies. But we will uh, do this online and actually create the strategies and backtest in front of you. Also, just one disclaimer before going ahead. So systematic trading in no way is any kind of guaranteed or assured returns kind of thing, something like that. There is nothing like that I know of. These are all basically mathematical probability based ideas that we have, and we are trying to maximize the probability and increase the chance of success, but nowhere in any way does this kind of imply any kind of guarantee. So you should kind of test it, hear it out, test it and try it for yourself, and obviously understand that derivative trading involves some element of risk. Having said that, let's move forward. Okay, so yeah, so just a little bit more about me. Broadly, I've been into the software side, also building algos for the last few years. So a lot of the, I mean, I would say whatever experience, little experience I have in the systems and technicals is all by actually building strategies by hand. I mean, like by software, but like not doing much of any formal kind of technical analysis courses. A lot of it is all due to testing and back testing, and that's what I kind of enjoy doing. And yeah, mostly everything else is said, so let's just move forward. Okay, what do you think is the problem? So the market is a complex place. The stock market is a complex place. Whoever you spent enough time, a fair bit of time, or even if some of you saw the rally of 2021 when market went up, but then in 22 things weren't the same. So it is a complex space because you have so much news and advice, especially both wanted and unwanted, and you get there is probably more of unwanted advice that we get. So there is all kind of data. You get institutional data, net FII, FPI, all those positions, then derivative data like open interest, obviously technical data that we study, like in terms of breakout, support, resistance, demand, supply, 52-week highs, things like that. Fundamental data can be like how's the economy doing, how's the GDP data, how's the wholesale price, consumer price inflation. And of late, interesting is alternative data where a satellite will scan maybe the gate of the factory, and it can find the number of trucks going in and out. So if the sales are shown to be X, then at least so many trucks have to cross, otherwise that data may be fudged. So some alternative data like that, like credit card spends, and these kind of things are being used in building trading systems and even investing ideas and things, typically being used more by the hedge funds and those kind of institutions who have the access to in the who invest in rather that kind of technology and have access to that. So why do we generally, most of us, when we try to trade, why do I think we fail when we have gone through we all who have traded manually and discretionary for a while will find that it's not very easy. You'll find very few discretionary traders, right? That is traders who are taking not using a strict mechanical system, but they maybe have some rules, but then they take their decisions based on quite a lot of other inputs also. This number of people, right, the number of discretionary traders who are successful, we are seeing over and over a period of time that that number is probably getting more challenging, and maybe not maybe smaller, right? Because it's not easy to continuously keep adapting and beating the machines or the robots, right, which have we are seeing have increased a lot. So last statistics as per NSE was about 66% of all the trading in the derivative market, right? 66% of trading is all FNO data, is all algo trading, sorry, right? Systematic or algo trading. So the activity has the more quantum of the activity has increased a lot, and that's why we are most of us are trying to find some complex solution to this problem. What we think the solution to this complex problem, if at all, is to build simple strategies. And in simple strategies, obviously we want to build strategies which have some edge, or positive expectancy, as we call it, and I'll talk a little more about that as we go forward. But the basic idea is that accepting losses is a part of the game. As much as we like profits, we all love profits, but it's like saying without having losses, how can we make profits? That is not something that is possible, which all the system traders or even individual traders who have done well will tell you after a while that the losses are going to happen at some point. There will be losing streak, and it cannot be that all 100% of the trades go right. Okay, simple reason is because we don't know what the market is going to do the next day. You don't know how other people are going to react to some news, some decision. And maybe there is someone who is probably has bigger size than what you're trading, and or has some information you won't have, or for whatever reason which is beyond our understanding, the market changes its direction and changes its action. So the only solution we think is to build a rule which will have losing phases and winning phases, and we should obviously aim to overall make money, right? So that is kind of the approach that I think I've been taking over the last few years, and it's generally been okay compared to at least a lot of the discretionary trading I used to do. I still use a small discretionary account. I call it like a cheat account, where I put some kind of small limited amount of money and I trade that, and I do whatever I want to do. But I kind of do that to ensure that I don't meddle with the systems which are running mechanically like robots. Okay, so yeah, so mainly that when we trade, we have two basic styles or philosophies, right? Any trader you'll ask will generally talk about this. So one is directional strategies, right, or directional approach. In this approach, we are basically saying no price is too high to buy and no price is too low to short. So for example, Bank Nifty is say close to 44,000, and say like it crosses the old high, whatever, 44 half or something, and it's a buy signal, or some people will come and say it's gone so high now, how much more high it can go. But a directional trader who's using a system or a method will buy the breakout because he or she expects that the price may continue to go up more. I don't know how much more it can go, right? And that's the mindset of a directional trader or a trend follower. Likewise, if some stock which was 130 rupees or something, it has now come to 30, say it is near its 52-week low or all-time low, and most people will come and start saying that, hey, it's fallen so much now, it's time to, the stock will go up, let's buy. But the directional or momentum trader is going to say that it's a sell signal on his or her system, so let's short because it can go further down. So no price is too low to short for the directional trader, right? Whereas on the other side, the non-directional trader is doing an exact opposite mindset. In the first example, where say the Bank Nifty broke out, right, and the directional trader is lapping on to the buy trade, a non-directional trader is actually going there and selling, because he or she thinks that once the price has come so much up,